Suzanne Peters here with eXp Realty. Just so you understand where I'm coming from, here's a graph of mortgage balances in the trillions. You'll note in about 2013, we started going up real fast. In fact, from the height in 2008, we have nearly doubled our equity. Now, does that seem like a reasonable gain? Let's put it this way. If we saw a correction of about 20%, it would put our equity right about here. Now, that's a reasonable gain. We are suffering from a bunch of homeowners thinking that their perceived equity is real. It's not. Rates are higher, you gain from the Great American Cash Giveaway, and it's not real. Here's a graph of HELOC balances. Now, you might note the massive downward hill that begets 2009 to 2012. Reason? People didn't have any equity, so they couldn't put seconds on their homes. Yet, with our found perceived equity, the sky's the limit. Here's a graph of seriously delinquent loans, and yes, the graph looks good, but remember I told you a couple days ago that FHA is still fighting foreclosures with loan forbearances, as is the VA. So the true number of delinquent loans is higher than this graph suggests. But here's the thing, foreclosures are higher, and they are regardless of government intervention, they are up similar to 2008. The point is this, we simply have to do better. If you have 10,000 people, 1% will either buy a house or know someone who's going to buy a house. At that point, you don't have to pay for any type of lead generation. That would equal 100 deals per month. Your goal and your only goal should be to get a massive database and then just love on it. If you want help, we at the Loan Factory have this whole thing covered. If you're a realtor like me or a lender, just reach out and we can make this thing happen. The form is down below. Now, here's part of the problem. In 2025, American corporations bought back $166 billion in their own stock. Why would they do this? It's like taking money out of circulation. When this happens, every dollar has a higher value. With the stock buyback, it makes existing stock worth more. Now, it's worth noting that we have bought back more stock this year than any other preceding year. By far, one could argue if a company is so flush with money, rather than buying stock back, that money could have been given to the workers. That move supports the middle class. However, they didn't do that, of course. The buyback keeps the money with the shareholders. Now, I don't bring this up because I'm a socialist. Rather, I bring this up because we are facing the same type of situation in housing. When people feel beholden to their 2.785 interest rate, they don't sell their house. When they don't create scarcity, the scarcity always makes the commodity more expensive. So we will have a new Fed chair in months. We will have one that will bring, in fact, quantitative easing back to the table, and rates are going to tumble. My question to you is this, and it's very simple. If we go back to an extremely low rate environment, will that ultimately help or hurt the housing market? I mean, we always want to feel good today, but are we ultimately paying a higher cost in the long term at the end of the day? Let me know what you think down below. And again, my name's Suzanne Peters with eXp Realty. I'd love to contact you and give you any other information you'd like to know on the real estate market.